Tonight, two of the absolute biggest names in tech report earnings, Alphabet and Tesla. After a wildly volatile week for semiconductors, the stakes could not be higher. Are we about to see a massive validation of the AI trade or a critical market breakdown? Hello everyone, welcome back to AI Market News. Today we're breaking down the market action for July 22nd, 2026, where all of us are watching investors position for what might just be the most consequential pair of earnings reports this entire quarter.
Let's begin with the setup based on available data. Monday's session on Wall Street was incredibly strong. The Dow jumped a massive 386 points, finally snapping a painful three-day losing streak. This really sets the stage for a top-down look at global market action today, and it helps all of us understand the exact momentum driving the market right into these mega-cap earnings.
Section 1. Wall Street rebounds and semiconductor strength leads.
Moving into our analysis of the U.S. equities rally, as you can see in the chart, the Dow Jones Industrial Average enjoyed a very strong close, finishing up 0.74% at 52,230. But it wasn't just the Dow. That upward momentum dragged the broader market higher with it, pushing the S&P 500 up 0.89% and propelling the NASDAQ up by 1.29%.
The catalyst here was familiar, but incredibly powerful. TSMC is reportedly negotiating price increases of up to 10% for AI-related chips starting in 2027. On top of that, Nvidia confirmed its next-generation Vera Rubin AI chip has officially moved into mass production. So here's the underlying mechanism at play for all of us. TSMC raising prices and Nvidia scaling up production means that high-end AI compute demand is still heavily outpacing supply. This signals strong pricing power and an accelerating product cycle, which completely reverses the recent market fears we saw about a potential memory chip oversupply.
Moving to Section 2, Asian markets, Nikkei reversal and yen highs.
Shifting our focus over to the Japanese markets, the graph shows a truly volatile session. The Nikkei 225 Nikkei Ninigo opened sharply higher, gaining as much as 1,300 points intraday to hit 67,592, but look at that sharp reversal through the afternoon session. It ultimately closed down 116 points. The mechanism here is classic risk management. Basically, sellers capitalized on those early highs to take profits off the table. Extreme caution reigned supreme as investors simply weren't willing to commit ahead of tonight's massive US tech earnings.
And looking at the currency markets, we are literally witnessing history right now. As the graph shows, the USDJPY pair crossed 163. The yen has officially hit a historic low of 163 per dollar for the very first time in 39 years. The mechanism behind these weak yen dynamics stems from a recent domestic policy shift. Japan removed fiscal consolidation language from its policy framework, which naturally softens the currency. This matters for all of us because a weaker yen historically boosts Japanese export equities by making their goods cheaper abroad, and it significantly impacts global carry trades across the region.
Section 3, Mega Cap Tech, the stakes for Alphabet and Tesla.
The stakes are incredibly high tonight with these major forward-looking catalysts. For Alphabet, the stock is already down more than 12% from its recent all-time high. This was driven largely by rumors that its next-generation AI model is delayed. Tonight, they absolutely need to justify their massive capital expenditures in cloud and AI to very anxious investors. Meanwhile, Tesla has fallen nearly 7% over the past 4 sessions. The market is laser-focused on Elon Musk's outlook on vehicle deliveries and margins, especially given the intense rising competition we're seeing in China, all against a highly uncertain macro backdrop.
Section 4, Macro Pressures, Yields, Oil, and the VIX.
Beyond just the tech sector, we have to look at the broader macro forces that are keeping institutional investors on edge. As you can see in the chart, the U.S. 10-year Treasury Yield climbed to 4.632%. This visually demonstrates a steady, restrictive grind higher in rates. Yields at these levels put heavy pressure on equity valuations, particularly for the growth and tech stocks we are so heavily focused on today.
Looking at energy, the graph shows crude oil WTI rising to near $87 a barrel. The underlying mechanism here is essentially a chain reaction. Ongoing Middle East supply concerns are pushing oil prices up, which in turn heavily fuels broader inflation fears. And it's those lingering inflation fears that keep bond yields elevated for all of us, creating a pretty tough macro environment.
Naturally, this specific combination of macro pressure and massive earnings anticipation breeds anxiety.
As you can see in the chart for the VIX, often called the fear index, we can visually demonstrate the market's pre-earnings nervousness. It is ticked up to 17.37, showing us clearly that traders are hedging their bets and bracing for potential volatility.
Finally, Section 5, the week ahead and key economic indicators.
According to current market information, here are the upcoming catalysts we need to watch to prepare for the rest of the trading week. On Thursday, we have the ECB rate decision and U.S. jobless claims in the morning Eastern Time, followed by Intel earnings right after the closing bell. Friday rounds out the week with Japan's June CPI, which is absolutely critical for those yen dynamics we just discussed, and the U.S. flash PMI readings. Looking just over the horizon, next week brings the FOMC rate decision on July 28th and 29th. But make no mistake, tonight's mega-cap tech earnings will ultimately decide if the semiconductor rebound continues to push markets higher or if this rally stalls out entirely. The stage is set, but are we on the verge of a summer breakout or a major tech correction?
Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.